In this brief video, we will be talking about understanding basic health insurance terminology that everyone needs to understand. The terms that we'll be covering will be premium, deductible, out-of-pocket, coinsurance, copay, and HSA. A premium is an amount of money that an individual must pay for their insurance policy. So when you're picking out an insurance program that works for you, what you pay on a monthly basis is known as a premium. Usually your employer is the one that would take money out of your paycheck and pay for that premium using the money that you've earned. The premium amount is going to be determined by you, and in that insurance policy, you will then decide on what you like to include and not include, and then that will determine the price of the premium. When we talk about an individual who owns a premium or owns a policy, they're known as the policy holder. We have something called a deductible. A deductible is the amount of money that the policy holder needs to pay before their insurance kicks in. So what that means is, if we have an example here of a policy holder who has a $2,000 deductible, and let's say they had 3 medical bills, $500, $1,200, and $400. Once you add those all up together, $2,100 would be the total. So what this is saying is that the policyholder needs to pay $2,000 out of their own pocket first before insurance will begin to pay for anything. So that $2,000 you see here, completely out of pocket, and then that $100, insurance will begin to pay. We have something called the coinsurance clause. And what this means is that the medical insurance is going to pay a percentage of the medical bills. So let's continue on with our example. Our policy holder has a deductible of $2,000 they need to pay before insurance will begin to pay anything. They have met that deductible and now have $2,100. Well, now that $2,000 is all the deductible. Now we take that $100, which is past the deductible, and now we're going to look at the coinsurance clause. For the example, we have an 80-20 or sometimes a 20-80 policy. To be honest, I don't know the exact way it is formatted, but the idea is that the insurance company is going to pay the larger amount. So for our example, we would find that the insurance company would pay 80%, and then the policy holder would then be paying 20%. So since we have $100 that's over our deductible, what this means is that the insurance company is going to pay 80% of the $100 and policyholder will pay 20%. So that would mean insurance pays 80 and policyholder pays 20. Again, coinsurance clause does not kick in until the policyholder has paid the entire amount of the deductible. For this example, it's $2,000, and now the $100 is past that. This is where coinsurance clicks in. Now, we have something called maximum out-of-pocket. And what that means is the maximum out-of-pocket means the policyholder will not have to pay a cent more past that maximum out-of-pocket. Meaning, for the example here, let's continue on. Policyholder, $2,000 deductible, medical bills, $2,100. That means now $100 goes to the coinsurance clause, 80-20. Now, the policy that this policyholder has selected, they have a $4,000 out-of-pocket maximum. So what that means is, up to this point, the policyholder has paid the deductible of $2,000. They paid the $20 on this coinsurance clause that was over their deductible. And once they have reached $4,000 and paying out of their own money after coinsurance, after the deductible, the policyholder pays nothing more. So let's say the next medical bill that comes in is $100,000. Well, that is for sure going to meet that $4,000 deductible. And any amount past that $4,000, the insurance company is going to pay fully. So again, maximum out of pocket means that the policyholder does not pay a cent more once they have reached that maximum out of pocket. Now, we have another term called copay. A copay is a flat fee the policyholder pays whenever they visit the doctor. So for instance, you're going in because you have pink eye. Well, when you go into the doctor, the lady or man at the front desk, they will say the copay today is, for example, is $20. And what that means is that you have to pay that amount, that $20. Copays does not generally contribute to the deductible. So remember that $2,000 deductible we discussed? The copays do not go towards that, generally do not. So you write a check for $20 or your card right there, you pay the copay and you see the doctor. It generally does not matter what you're going in for. The copay is a flat fee that you pay each time. Now we have something called an HSA account. An HSA is a health savings account. And what that means is that it is money designated to go directly to medical expenses. Sometimes your employer will put money into the HSA for you. You can contribute You can contribute money into your HSA account, and it is tax-free, meaning that let's say that you make $30,000 a year and you take $5,000 of that and put it directly into your HSA account. The IRS will look at you as if you only made $25,000 instead of the $30,000. So an HSA is a great way to save some money from your taxes, but also it's a great way to have money set aside for paying medical bills. So for instance, what is an example of that? You can use it for your copays, you can use it for prescriptions, medical bills, and there's also medical other things that you can purchase for it using the HSA. Now, how do you choose a medical plan? How do you know which one to pick and which one to avoid? Well, it really comes down to how often do you go to the doctor. If you rarely go to the doctor, you probably want to pick a plan that has a higher deductible and a lower premium. And what that means is that the deductible, you have to pay a higher amount out of your own pocket before your insurance will kick in. But here's the other side of it. If you only go to the doctor once a year, there's no reason to have a lower deductible because you're not going very often. So the higher the deductible, the lower the premium. And again, the premium is that monthly bill that you pay for your medical plan. So looking at this example here, we have $8,000 deductible that needs to be met, and we're paying $125 a month, which would accumulate to $1,500. So with all of that, $9,500. And again, the reason why the premium is so low is because the medical insurance pays less for the policy medical bills. So you're taking on more of the burden of paying your medical bills versus not. And again, someone who doesn't go to the doctor very often, this is the right plan for you. The other plan is having a lower deductible and a higher premium. And if you go to the doctor frequently, or if you have a family that goes there and you have several children, that would make sense to have a lower deductible because you're going to be going to the doctor more often. We have here a higher premium, and the higher premium is saying that $400, which would then annually be $4,800. So our total amount after deductible and the premium would be $6,800. The reason why your premium is more expensive, the medical insurance is paying more for your policy's medical bills. So that's the difference. So if you're going often, you want a higher premium. If you don't go very often, you want to go with a lower premium. It all comes down to the deductible. And if you have a emergency fund with $30,000, $40,000, $50,000 in it, well, you could probably pick a plan like this because $8,000, even though it's painful to pay, is not going to be as painful for you because you have the money set aside. So you can take more risk on that one. So this is just a general overview of some of the basic terminology that you should understand when it comes to health insurance. If you have any questions, let me know.